You're sitting at the top of a 200-foot drop, the chain lift clinking beneath your feet. It stops, and for a split second, there's a pause. Then you drop, and there's nothing going on but the wind and the rush. That's what Six Flags sold to millions of people for over 60 years. But for the people holding the company's debt, the drop was a lot more permanent and didn't come with a safety harness. Six Flags' story is a roller coaster ride. It went from being a regional powerhouse to a bankrupt shell. Then it tried to insult its way to becoming a luxury destination, only to end up needing a Super Bowl champion to help save it from its own balance sheet. By the time we get to the final $1 billion gamble in 2026, you'll see how a company that specialized in controlled fear ended up terrified of its own customers. The story starts in 1961 with a real estate developer named Angus Wynn. He had a vision for a theme park that was more than just a local carnival, but wasn't quite the fantasy land Disney was building in California. He opened Six Flags over Texas with a $10 million investment, featuring 6 distinct themed sections standing for the different nations that had governed Texas. It was an immediate hit, drawing more than 500,000 visitors in its first short season, because it offered high-quality entertainment that families could actually drive to. For decades, Six Flags was the gold standard for regional thrills, expanding into Georgia and Missouri and eventually becoming a staple of the American summer. But the real trouble started when the company stopped being a park operator and started being a financial pawn. In the early 1990s, the chain was shuffled through various corporate hands before Time Warner took full control. By 1995, Time Warner was already looking to offload the majority of its stake to a group of institutional investors for about $1 billion. This era marked the beginning of the structural flaw that would haunt the brand forever: the belief that bigger was always better, regardless of the cost. In 1998, a much smaller operator called Premier Parks decided to swallow the giant. Premier Parks agreed to buy Six Flags in 1998 for just around $1.9 billion in a deal that created one of the largest regional theme park companies in the world. Time Warner walked away with hundreds of millions in cash, while Premier Parks inherited a massive portfolio of around a dozen parks and a mountain of new debt. Under the leadership of Kieran Burke, Premier Parks went on a spending spree that felt like a kid with a credit card in a candy store. They didn't just buy the Six Flags brand, they started rebranding their existing parks, like Adventure World in Maryland, to the Six Flags name to capitalize on the name recognition. And they were buying parks in Europe and Mexico, trying to build a global empire. By the year 2000, the company had officially changed its name to Six Flags Inc. to reflect this new identity. But the growth was fueled by debt. The company was adding more coasters and more locations, but it wasn't necessarily adding more profit. The physical decay of the brand became visible in the most tragic way possible in 2005. When Hurricane Katrina hit New Orleans, the Six Flags park there was submerged under several feet of water. While the company initially talked about rebuilding, the park was eventually abandoned, left to rot as a rusted, graffiti-covered skeleton. For many, the sight of the abandoned Mega Zeph coaster became a symbol of a company that had expanded too far and didn't have the resources to take care of what it owned. By the time the Great Recession hit in 2008, the corporate structure was buckling under a debt load of roughly $2.7 billion. In June 2009, the ride came to a full stop. Six Flags filed for Chapter 11 bankruptcy protection. The filing was the result of years of trying to outrun their interest payments with more and more expansion. The company's Great Adventure unit alone was listed with billions in liabilities in the court documents. It was a total collapse of the 1990s expansion model. When they emerged from bankruptcy in May 2010, the the company had shed about $1.7 billion in debt, giving them a fresh start but leaving their reputation as a stable investment in tatters. After the bankruptcy, the company spent a decade trying to find a new track. They leaned into a value model offering cheap season passes and memberships that essentially turned the parks into a low-cost summer daycare for local families. By 2019, they were using a tiered membership system to compete with Disney's rising prices, positioning themselves as the accessible alternative for the middle class. They even tried to launch a massive expansion into China, but that project was plagued by delays and eventually fell apart, causing shares to tumble as the company had to admit the new parks weren't coming. The real cultural shift happened in 2021, when Salim Basol took over as CEO. Basol didn't like the value brand identity. He wanted to pivot the entire company toward a premium experience. But the way he went about it alienated the very people who had kept the parks running for 60 years. During an earnings call in August 2022, Basol infamously suggested the parks had become a daycare center for teenagers, and that the company had been catering to the wrong demographic. He wanted to raise prices to attract what he called a more affluent customer, essentially telling his core base that they weren't welcome anymore if they couldn't afford the new higher costs. That approach led to what analysts later called a seriously scary summer. In mid-2022, Six Flags reported that attendance had plummeted by 22% compared to the previous year. The parks were emptier, and while the people who did show up were spending more per person, it wasn't enough to make up for the loss of millions of visitors. The company's revenue fell, and analysts at Citi and other firms began downgrading the stock, citing the risk of a recession and the faltering attendance numbers. Fans were furious, and the parks were increasingly seen as overpriced and under-maintained. Safety incidents didn't help, like when several people were hospitalized after a malfunction on the El Toro coaster at Great Adventure. By 2023, the premium experiment was clearly not delivering the promised windfall. The company tried to walk back some of the damage by launching events like Strollerpalooza to try and win back families, but the damage to the brand was done. Faced with a stagnant stock price, the board looked for an exit strategy. That came in November 2023, when Six Flags announced it would merge with its longtime rival, Cedar Fair, in a deal valued at approximately $8 billion. This was pitched as a merger of equals, but it was clearly a move driven by the need for scale to survive in an increasingly difficult theme park market. The merger was completed on July 1st, 2024, creating a massive new entity called Six Flags Entertainment Corporation. The new company operated 42 parks across North America, including some legendary spots like Knott's Berry Farm and Cedar Point, alongside the legacy Six Flags locations. The leadership team promised $200 million in annual synergies, but the truth was that they were still grappling with a huge debt load and a brand that people were avoiding. If you're still watching, you're exactly who this channel is for. We're trying to get to 100,000 subscribers in 2026, and by clicking that subscribe button, you don't just stay in the loop for future videos. You help us to grow and make the best content we can. Thank you. The honeymoon period for the new merger didn't last long. By late 2024, the new Six Flags was already showing signs of the same old problems. The company announced it would invest more than $1 billion over the next 2 years just to try and enhance the guest experience. A massive capital outlay for a company that was still trying to find its financial footing. When they reported their third quarter results for 2024, they had to admit that attendance at the legacy Six Flags parks was lower than they wanted, although the legacy Cedar Fair parks performed better. The real shock came in November 2025. the company took a massive $1.5 billion impairment charge, an accounting entry that records a sudden drop in value while admitting that the company is worth less than they previously thought, and it was forced to slash its financial outlook again. Revenue was falling as demand continued to drop across the board. Moody's responded by downgrading the company's credit ratings, citing the weak operating performance and the high leverage. This financial bloodbath caught the attention of activist investors. Jana Partners, a firm known for shaking up struggling companies, began building a stake, and they brought a unique weapon with them: Kansas City Chiefs star Travis Kelce. In October 2025, reports surfaced that Kelce had teamed up with Jana Partners to push for changes at the company. The idea was that Kelce's star power would help revive the brand's image and attract a younger, more engaged audience that the premium pivot had scared away. The news sent the stock jumping, as investors hoped the Kelce effect would do what corporate consultants couldn't. Under pressure from activists, the company's leadership underwent a total shakeup. Old CEO Salim Basol was out, and in November 2025, the board announced the appointment of John Riley as the new president and CEO. Riley was a veteran from the Cedar Fair side of the business, and his appointment was seen as a return to more traditional, operator-focused management. Riley faced the grim task of cleaning up the balance sheet. He started looking at selling off land and underperforming assets to unlock value. This included the heart-wrenching announcement that the company planned to close the iconic Six Flags America and Hurricane Harbor in Maryland after the 2025 season. As the company entered 2026, the strategy was no longer about global domination or premium exclusions. It was about survival. The company tapped the junk bond market in January 2026, offering $1 billion in senior notes at a high interest rate of 8.625% to pay off older debt that was coming due in 2027. They were essentially taking out a high-interest credit card to pay off another one, all while trying to keep the lights on and the coasters running. As of the making of this video, Six Flags has almost come back to the start of the ride. It started as a single, high-quality park in Texas built on a dream. It became a global monster built on debt. It tried to become a luxury club built on insults. And now, in 2026, it is a leaner, more desperate entity that is literally selling the ground beneath its feet to stay afloat. While the company still wins golden ticket awards for its rides, the financial reality is a roller coaster that most people would be too terrified to ride. The big downward dip of Six Flags wasn't a single event, but a slow, decades-long descent into a debt trap that even the world's most famous tight end might not be able to pull them out of. They are still predicting strong attendance and growth thanks to good early sales of 2026 season passes, but the market is watching the debt, not the turnstiles. After all the corporate maneuvering and the multi-billion-dollar mergers, Six Flags is still just a company trying to figure out how to pay for the next big drop without losing its seat in the process. Thanks for watching. If you want more details and to be amongst the first to know about things like distressed debt, leveraged finance, and bankruptcies, maybe even before they're known to the public, you need to be on my list. Join my credit newsletter using the link below to see what's really happening as it's happening. And click the video above to find out how another supposedly bulletproof company fell.